Multifamily investment returns come from three sources: income, appreciation, and tax benefits. While income and appreciation are widely understood, the tax benefits tend to be less well known. Real estate is a physical asset, and its condition tends to degrade over time. Roofs wear out, plumbing systems leak, finishes become outdated. To account for this, tax rules allow the owner to depreciate the value of the property each year and to record this as a non-cash expense on the income statement. This depreciation expense is one of the major tax benefits of multifamily ownership because it serves to reduce the property's tax liability without impacting the cash available for distribution, because it's a non-cash expense. As a result, property owners have a strong incentive to take as much depreciation as they can every year. One of the ways that this can be done is through a strategy called cost segregation. Let's talk about what you need to understand about cost segregation as a multifamily investor. Hi, my name is David Weiner, and I'm known as Mr. Cashflow. Thanks for joining me. Stay with me, because this is information that can generate crazy cash flow for you, and I'll have a special free offer for you at the end of the video. I presented this information at the Georgia Society of CPAs this year. Subscribe to my channel for more videos that can help you increase your cash flow, lower your expenses, save taxes, and minimize risk. Please smash that like button and share this video with those you know it might help. Leave me your comments and questions in the comments section below. I'll answer any questions personally. Very simply, cost segregation is a strategy used by property owners to maximize the amount of depreciation taken each year. To understand how it works, it's first necessary to understand how depreciation expense is calculated. Without cost segregation, tax rules allow multifamily assets to be depreciated over 27.5 years using a straight-line methodology. This means that depreciation expense is calculated by dividing the property's cost basis by 27.5. For example, if the property basis is $1 million, it can be divided by 27.5 to obtain $36,000 plus in allowable depreciation expense each year. Now, cost segregation involves reviewing every aspect of a property and segregating the property into different buckets for which depreciation can be accelerated. For example, a parking lot falls into the category of land improvements, which can be depreciated over 15 years. Kitchen appliances fall into the category of personal property, which can be depreciated over 5 years. By dividing a property into its components and depreciating them over a shorter time period, depreciation expense is maximized and the resulting tax liability can be significantly reduced. Let's look at the categories of cost segregation. Remember that a multifamily property as a whole can be depreciated using the straight-line 27.5-year methodology. A cost segregation study seeks to categorize those components of the property into 4 buckets, each of which is depreciated over a different time period that corresponds to the asset's useful life. Number 1, personal property. This would include items such as furniture, carpeting, fixtures, window treatments. Normally, it can be depreciated over 5 or 7 years, and the result is significantly increased depreciation expense for these items. 2 is land improvements, sidewalks, fences, docks. They can also be depreciated over a 15-year period. Within allowable parameters, owners should seek to maximize the values attributed to this category. And then you have the building. The building components, structural, such as the roof and the plumbing systems, can be depreciated according to this category. Owners should seek to allocate the maximum value they can to this category because any residual value is attributed to land after this. And then 4th category is land. Any amounts not allocated to the previous 3 categories are allocated to land and depreciated as such. With each of these categories, particular property, there are some subdivisions that can make trying to do this alone problematic. A third-party engineering-based cost segregation firm should be retained to complete the study. There's a cost for the study, but it usually pales in comparison to the potential tax savings it can generate for you. Currently, there are some other provisions, thanks to the 2017 Tax Cuts and Jobs Act and the 2020 CARES Act, that make having a cost segregation study done right now almost a complete no-brainer. The Tax Cuts and Jobs Act brought us 100% bonus depreciation, which allows all of that shorter life property to be depreciated 100% immediately. And the CARES Act allows us to use most renovations done on the property to also be depreciated immediately, and if you qualify as a real estate professional, to carry back any net operating losses created by these huge additional deductions for 5 years and get refunds on your previous year's taxes paid, all without having to amend your tax returns. Cost segregation, especially with bonus depreciation, is an extremely effective strategy for lowering a property's tax liability. I'd like to show you at no cost or obligation how it might impact your particular tax situation. So here's my special offer for you. If you email me this information about your property or portfolio, I will have a preliminary analysis created for you. It only takes about 48 hours. It will show you exactly what an engineering-based cost segregation study from the #1 cost segregation firm in the United States would cost you, and approximately what the tax benefit would be for you specifically. If you have property worth over $200,000 that was built or purchased in the last 10 years, why wouldn't you want to know what kind of cash flow you could be entitled to? Let me know what you think in the comments below. Like and share this video with those who might benefit from it, and subscribe to the channel for more help with your cash flow and taxes. I'm David Weiner, Mr. Cash Flow from Cash Flow Strategies. After all, it's your money. Keep more of it.